The Fed stopped raising interest rates in 2006, the summer of 2006. Everything was fine, right? Until the summer 2007, when we started getting cracks in the real estate market. And the Fed raised rates 425 basis points from 1% to 5.25% over 2 years. Now we've gone from 0 to 5.25%, 1 year, plus QT, plus banking crisis. I don't think we have to wait a year before the bottom to fall out.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for May 16th through May 23rd, 2023, while supplies last. This week we feature the silver Krugerrand at $3.99 over spot. For years, the Krugerrand was the most known bullion coin in the world, and in 2017, the South African Mint and Rand Refinery began minting a silver counterpart to the famed gold Krugerrand. The silver Krugerrand bear the springbok antelope on one side and the portrait of Paul Kruger on the other, and have a face value of 1 rand. They come 25 to a tube, 500 to a monster box, they are IRA eligible and are renowned for recognizability and design. Best of all, they are only $3.99 over spot while supplies last. To order this special or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Pento from Pento Portfolio Strategies. Michael, thank you so much for joining us today.
Thanks for having me on, Elijah.
Well, it's great to have you back on. I did want to discuss the ongoing banking crisis. Since we had you on last, another bank has failed, First Republic being taken over by JP Morgan and kind of the FDIC as well. And we're also seeing the debt ceiling is coming up real quickly here. It seems like these could come to a head kind of together here. Your perspective right now, I guess if we wanted to start on the debt ceiling, the long-term ramifications of what is happening right now.
Well, other than the erosion in confidence in the U.S. government and their ability to pay their debt, I think the biggest takeaway here is that we're going to have a fiscal tightening to go along concurrently with the massive monetary tightening. So we had the biggest monetary tightening in history globally. There were over 80% of the world's global central banks were tightening monetary policy in the past few years, post-COVID. And joining that monetary tightening is now going to be undeniably, even if they reach a debt ceiling, which I'm 99% sure they're not going to just, both parties are about power. So, at the end of the day, they're going to want to maintain power and not get dragged from the building and hung. So, of course, I don't advocate that, but that's what would happen if we defaulted on our debt. I actually think if we defaulted on our debt, it would just be tantamount to a balanced budget amendment, which wouldn't be the end of the world. But you'd see a lot of people go without their monthly stipend from the government, and that would cause a huge problem. So we're going to have a situation where we're going to have a dramatic and trenchant increase in fiscal tightening. There'll be trenchant, deep cutting fiscal spending, because otherwise Speaker McCarthy is not going to be able to get that deal through Congress. He has to get it. He won't put it for a vote on the floor unless he has his party going along with it. And his party isn't going to vote for it without significant spending cuts. Maybe not as much as they passed in the bill that they passed to send to the Senate, which died, it wasn't even put to the floor for a vote. But it has to have, as I said, deep spending cuts. So look for fiscal tightening to run concurrently with monetary tightening. That's the big takeaway.
That seems very interesting because, as you mentioned, there's monetary tightening and also now there's fiscal tightening. What kind of impact is that going to have on the economy?
Well, as you know, it's not going to be a very good one. So we know that the Fed has raised rates from 0% to over 5%, 5.1 on the effective Fed funds rate in just a little bit over a year. I mean, that has never happened before. We had 10 of the last 14 years at 0% or virtually 0% interest rate. Never happened before. And that led to a triumvirate of asset bubbles. Huge, unprecedented asset bubbles in the big three asset classes. You have stocks, you have bonds, you got real estate. And let's just talk about those three bubbles for a second. Just what we have engendered in this country and indeed throughout the world. So stocks were at the apex 200%, 205% to be exact, of GDP. Never before happened in history. The normal ratio is about 88%, not 205% of GDP. So prima facie evidence of a massive bubble in stocks based upon that unbelievable, massive, unprecedented distortion in interest rates, which again is a prima facie evidence for a bond bubble. 0% interest rates for 10 of the last 14 years, $17 trillion of global debt with a negative sign in front of it. Bond bubble of unbelievable proportions. A real estate bubble where we had the price of a home relative to the income reach an all-time record high, but even higher than it was in 2005. Home price to income ratios, all-time record high. We have 14 million homes that are owned by investors. This is a record amount of homes owned by investors, which can come on the market once real estate prices start to fall. So you have those three triumvirate of bubbles, I call it. Plus you had, you had the bubble in SPACs, you had the bubble in Bitcoin. So there automobile bubbles, the automotive bubble is huge. So you have all of these ancillary bubbles combined with the three major bubbles. And so you ask, well, what is fiscal and monetary tightening going to do to that? Well, it's going to burst those bubbles. They're all in the process of bursting. It's just taking more time for it to consummate. And let me tell you why. Let me tell you why I think it's taking more time. So, and this is going to require a little patience on the part of investors who are, I'm sure that your audience is saying, wait a second. You're saying that we have these massive bubbles. The Fed has raised their interest rates. Well, first of all, you have to understand. The Fed raised rates starting in March of 2022. That is when they started raising interest rates. And monetary policy works with a lag, usually around 12 to 18 months. So we're just seeing that effect of higher borrowing costs on the consumer and businesses starting now. So that's number one. But here's the biggest reason why we have a delay here. If you look at the M2 money supply, it is up since 2020. We have an increase of 42% of M2 money supply. Now, in the last 2 years. Now think about that for a second. The money supply, a broad money supply, not just the base money supply, which has gone from 800 billion to went to 9 trillion at the high, 800 billion in 2008 to over 9 trillion. Even with that base money supply, it is nothing compared to the broader monetary aggregate M2 going up 42% in 2 years. So never before happened in the history of mankind. So that has to start, even though it's falling now, it's down over 4% year over year. But that buildup in money supply has to be drained from the economy. So as that happens, you're going to see these asset prices continue to melt down. It's just going to take a little more patience before we see the entire meltdown. And by the way, I'm not rooting for a meltdown to happen. It's just what the economy needs to be healthy. After all, don't you want to have an economy that is based on market forces and not just the endless manipulation of interest rates and money supply by central banks? That's what we all should need. Don't you want, I'm sure you do, because you're a nice religious person. Don't you want home prices to be affordable so the first-time home buyers can buy them? Don't you want retirees to have a real interest rate on their savings, which they haven't had for over a decade, maybe even longer than that? So we want to have safety in the stock market. We don't want to have these iterations of massive bubbles and then 50% spike down in the major averages. You just can't have that anymore. So I'm hoping and praying for a viable investment environment which has low taxes, low interest rates, low inflation, and stable prices. That's what we want.
It definitely would be a good thing to have a healthy financial system, something based on something real and not these bubbles that are, blown up to extreme proportions here. I did want to ask you, though, kind of in the interim, as we do see this collapse, if this happens as you are forecasting, you have mentioned how we haven't even hit a recession yet, but 4 major banks collapsed in the U.S. What should we be anticipating as the recession hits? What should we be anticipating in the economy and also specifically in the banking system?
Well, first of all, the reason why we don't have more than 4 banks collapsing is because the Fed launched something called the BTFP, the Bank Term Funding Program. If you notice, that was a $400 billion increase in money supply, base money supply, in 2 weeks. So the Fed has pretty much backstopped the entire banking system. But here's the real problem, though. That just sort of puts your head in the sand and punts, whatever you want to phrase you want to use. The real problem with the banking system is this: that I can get over 5% in a risk-free, and I'll put that in quotes, risk-free T-bill. But in the banking system, I'm getting 0.05%, 5 basis points. Okay, that's the real problem in the banking system, because they have decades of loans that were making almost 3%, 4%, 5% more. And if they were to pay depositors the same rate that they're getting on their loans, which are their assets, they'd be out of business, upside down, bankrupt. So they can't do that. And yet, if they don't do that, the calculation that's being made, they call it a bank walk, not a bank run. I guess you can call it that if you want to. I made the same calculation, Elijah. I said, I have a lot of money in this bank. I'm getting nothing for it on a liquid. They call it a demand deposit. I mean, I could lock it up for a year and get, 4%, or I could put it in a extremely liquid T-bill and get over 5%. It's a no-brainer. So reserves, deposits are leaving the banking system. And that goes along with quantitative tightening, which continues, which is reserves leaving the banking system. And then you have the third part of that, which is to come, is their assets will start to erode in value, which will cause them to sell those assets to reach liquidity and redemptions, which will destroy the banking system capital. So those are the things still to come. So no, the banking crisis is not resolved.
In your most recent article you wrote in the beginning of this month, you mentioned how one of the regional bank ETFs, the KRE, is down 40%. Yeah, 40% from February 7th, I believe, of last year. So what does this definitely signals just what you're saying, is the banking crisis is not over.
It's not over at all. It was put on the back burner by the Fed with this BTFP program, but the fundamental problem in the banking system is what I just laid out for you. That's why the KRE is down 40% in the last 3 months. People are walking away from the bank and seeking a real yield on their money. It's just simple. It's a simple calculation, and the banks can't do anything about that right immediately, because as I said, I wrote in my article, which really bugging the banking system, their assets are 3-4%. Mortgages hit an all-time low, I think, of 30-year fixed, 2.89%. Those are the bank's assets. That's what they're collecting their money on. How the heck can they pay more than that? Imagine them paying 5% on a loan that they're getting 3% on. Doesn't make any sense. So the banking system's in big trouble, and that's where a lot of the capital and money comes from to run the economy. We have a debt economy. We have a debt-based monetary system. If banks don't have the reserves and the capital, they just can't make those loans. And that's all coming. I mean, it's happened. The process has started. It's happening now. It's just dragged out because of that 42% increase in money supply that's still sloshing around Wall Street primarily. But the S&P is still down, 13, 14, 15% from its high. So we're not talking about a major bull market here. Its high was reached in the end of 21. Beginning of 22. So we're not talking about a major bull market here. We're talking about a market that's kind of treading water in a trading range, mostly lower, but it's not falling off a cliff yet. It will. but be patient. And that's why, by the way, that's why I created my model. I mean, my model has kept me from being overly bearish. I want to be bearish. I have all the figures in my head. I know how much debt we have in the globe. $305 trillion in global debt, according to the IIF. Near record percentages of GDP across the board in the public sector and the household sector, the business sector. Massive increase in interest rates, and now a tightening in fiscal conditions. So we're just going to be patient. The Fed stopped raising interest rates in 2006, the summer of 2006. Everything was fine, right? Until the summer 2007, when we started getting cracks in the real estate market. The Fed raised rates 425 basis points from 1% to 5.25% over 2 years. Now we've gone from 0 to 5.25%, 1 year, plus QT, plus banking crises. So I don't think we have to wait a year before the bottom to fall out.
With respect to what this might look like in the banking system, a lot of people are focusing on the regional banks and saying, these are the ones in trouble. But as you mentioned in our last interview with you, also the big banks are in trouble as well. So what might this look like as the crisis starts hitting the big banks as well?
Well, I mean, if you I don't understand, Elijah. I don't understand everything. What I don't understand is how is it possible that me as a depositor will not accept 5 basis points at Silicon Valley Bank, but I'll accept 5 basis points with JP Morgan. Does that make any sense to anybody? No. I mean, it's the same dynamics. It's the same type of loans. I mean, JP Morgan is a big money center bank, so they do other things. They do trading, but the basic dynamics of their loans paying less than T-bills are in place in both regional banks and in large money center banks. It's just more prominent in the regional banks because that's all they do. They don't get involved in a lot of trading. So there's stress throughout the banking system, and I would not run from Silicon Valley Bank to Wells Fargo or JP Morgan or Morgan Stanley and look for some kind of safe harbor there. If you really want a yield that's safe, go to T-bills and get all the liquidity. Go to a money market mutual fund. Get all the liquidity more liquidity than you have at a bank, with more safety, because the FDIC, by the way, only covers $250,000 per account name, and that's not the case in a brokerage firm. You get much more.
Now, these big banks, those are considered to be, systemically important. So if we do see those banks having issues, it seems like it would be a bigger shock to the financial system than just, SVB or First Republic going under.
I think the big takeaway here is that, first of all, 2 things. Silicon Valley Bank was systemically, a SIFI bank because it has to be, even though it wasn't officially designated as one, because we bailed out them. I mean, we bailed out the entire banking system with this BTFP program. Okay, I mean, they went under. I get that, but we bailed out banks like that, same size, similar size. PacWest and all these other Western banks that were going under in California through the BTFP. But the dynamic I want you to take away is not that we don't need JP Morgan to fail for the stock market to correct, or for home prices to correct. Or for junk bonds to collapse, or collateralized loan obligations to reset, which all those things are going to happen, in my opinion, my strong opinion. The function I want you to understand is that bank lending is going to be severely impaired. So the net percentage of banks that were making loans more restrictive to customers was at a recessionary levels before we had this banking crisis, before the Fed raised rates by 500 basis points, and we had this slow walk from the banking system as depositors into money market funds. So the big takeaway here is that, again, fiat debt-based monetary system, bank lending is severely impaired. The economy contracts through contracting money supply and loan growth, and you get a recession, and earnings growth plunges, as we already see negative earnings growth now, and then the stock market resets. That's the dynamic.
And if you could expand also on the program that the Fed has put forth that obviously increased their balance sheet quite a bit, where banks can essentially just give them distressed assets in exchange for cash. Why isn't that a solution to this crisis right now?
Well, the bank term funding program is even better than the discount window. It's like a new improved discount window. So let's suppose I have a long-term treasury bond that I bought it yielding 1%, and now it went to yield 3%. So the price went down and the yield went higher. And if I had to realize the loss on that bond, I'd book that loss, and my capital goes down as a bank. So I don't have to do that anymore. I can now take that treasury bond to the BTFP and get par, full value for a year. So it's a loan with interest. So it covers up the problem, but doesn't solve the problem. The problem is still that bond yields are much higher than they were a year ago. So anybody who bought bonds was just piling into duration treasury bonds is underwater. So it fixes the problem. It doesn't solve the problem. It covers the problem for a year, because at the end of the year, unless the Fed rolled over this program, which is in effect monetizing this debt, which I don't think they're going to do right away, at least, unless there's a panic in the stock market, which I'd like to capitalize on before they do these, shenanigans once again. At the end of the year, I have to buy back from the Fed at par the Treasury and take the asset back as a bank. So that's a big problem. Plus, I have to pay interest. I think it's 4.7% interest on the loan. So this is just covering covers up the problem in the banking system. If I have a balance sheet that's upside down, and I hand it over to the Fed, and now I have all this liquidity, I'm not going to go out and make a bunch of loans with this and gamble, because I know at the end of the year I'm going to have a big problem. I have to pay back this loan with interest. So I call it QE light. It's not the same as QE. And as you notice, by the way, that's happening a lot less now. You see the Fed's balance sheet is now starting to roll over once again.
It definitely is a temporary solution. It's just a Band-Aid, as you mentioned. You did mention in your article, though, that the real, the only solution to this crisis would be for the Fed to really reliquify the system, which is kind of partly what they're already doing through this program. But that just creates more inflation. So it doesn't seem like there's really any good solution to this issue.
So this is poor Jerome Powell. Poor Jerome Powell. He was unwise enough to be buying mortgage-backed securities in the first part of 2022. Why were we still, the extent you had inflation that was running it was approaching double digits. It went up to 9% at its high. It was on its way to 7, 8, 9%. And he's still printing money and expanding the base money supply. Fed credit plus physical notes and coins, which is base money supply. That's the basis of all other monetary aggregates. Why were you doing that? But poor Jerome Powell, he creates this 9% inflation. Then he blames some kind of, ephemeral supply chain. That's what they all say. I heard Janet Yellen too on program saying, the host said, well, why do we have such inflation? And she, waxed and waned about supply chain bottlenecks and the war and all this stuff. Hey, Janet, did the Federal Reserve and the Treasury have anything to do with the inflation? The Treasury handed out the equivalent of $6 trillion to the economy, and the Fed monetized $4.5 trillion of it. Did that have anything, maybe a little bit, to do with inflation? So Powell has a difficult task right now. If he says, okay, let me just go back to ZIRP, I'll make the BTFP permanent. You think inflation is going to go down to 2%? No, it's still at 5%. Inflation year over year, it's 4.9%, Elijah. That's not 2. So maybe it goes down to 3 in the next couple of months due to base effects, but 3 is still 50% more than 2. So the idea that you can now just say, okay, let's just reliquify the banking system with impunity, it's just never going to happen. Because what is going to happen if he does that is you'll see inflation wax much higher than 9% were topped out before, because people will be completely and utterly aware that the central bank's bluffing. They can't raise interest rates. They can't keep them in real sense for a very long time. They can't drain the money supply. They can't prick asset bubbles. So it's going to be, inflation will wax higher in this country. It'll be rising to a rate never before imagined in the United States.
And you mentioned Janet Yellen being asked about inflation. And at the end of the day, the primary cause of inflation is the increase in the money supply, as you mentioned, where the supply shocks and the war may have been, in some sense, the secondary cause. But it really comes down to there's more money in the system.
Elijah, 42% increase in M2. Elijah, the Fed, normally what the Fed would do, let's forget about 1913. 1913 was just a discount window operation. But what they have been doing for the past few decades is increasing the base money supply. So it's reserves, banking reserves. And then the hope was, well, interest cost of money goes down because they're buying all these treasuries and mortgage-backed securities. Cost of money goes down. Banks go out and take these reserves and they buy more mortgage-backed securities and treasuries. And, we just force interest rates lower and lower. And then, creates a boom. Free money is, conducive to a boom in its broader aggregate creation. So the M1 base money, which is M0, then you have M2 and M3 don't even count anymore, but shadow stats will count it for you. But they boomed. What we did this time, post-pandemic, is we did something called helicopter money. So we just didn't increase base money supply. We actually had the Treasury hand out trillions of dollars, in PPP loans and checks, direct checks to consumers. Well, where'd that money come from? It was monetized by the Federal Reserve. So it wasn't just an expansion of base money supply. It was a direct end run around the banking system with sending checks to people and businesses. So that's what caused M2 to actually absolutely explode higher. 2 years, 42%. I'm going to hammer that. That has never happened before. In 2 years, maybe we go up 2, 3, 4%, 42%. So that's all this money still sloshing around the system. And that's why it's taken a lot longer for this for the market to really hit a brutal bear market. But it's coming because the money supply is shrinking, fiscal tightening is coming, and asset bubbles are teetering on breaking down, and they will.
No, we have a viewer's question here. Anthony asks, there was ample evidence that banking and economic crises would start in Europe or Japan. If and when that happens, what will be the impact here in the United States?
The recession that we see incipient fashion is global. It's not just the United States. So it's in the EU, it's in Japan. Japan actually had a pretty good GDP print recently, but it was even it was hailed and ballyhooed as some big economic miracle. It was like 1.5%. I mean, quarter over quarter seasonally adjusted annual rate. So this is a very weak global economy. You look at the IMF is consistently lowering potential economic growth, and the reason is very clear, is because we have more debt today than at any other time in history. In nominal terms, by a lot, $305 trillion globally. And as a percentage of GDP, it's also at or near a record high, even higher than it was in many cases, in fact, in all cases, than it was prior to the global financial crisis. So when you have that much debt, the amount of growth is impaired significantly. And the level of interest rates it takes to break that bubble in the economy is less and less. So we've already eclipsed it in the United States. We're getting very close to that level in Europe. Japan, by the way, is still clinging precariously to a 0.5% cap on their 10-year JGB, Japanese government bond. Now, there's a crisis there coming. You either have there's two ways that this could end. Either they break that cap, and when you have 4% inflation and rising in Japan, and a currency crisis in Japan, you break that cap and those rates will shoot. They're not going to go to 1%. They'll go to 5%, from 0.5 to 5 very quickly. So you'll wipe out that economy. And if you don't raise that cap, you're going to continue to print yen to buy every single JGB issued, because nobody wants a J. No private sane entity would buy a bond yielding 0.5% going out 10 years when inflation is 4% and the nation's insolvent. Nobody makes that calculation. So they have to continue to print yen to buy all the bonds, which is continuing to weaken the yen, which pushes up export prices in this island nation, which has almost no natural resources. So it's not a sustainable situation, and it's global.
Now, in light of all of this, definitely the hard economic times ahead, a lot of people are looking to precious metals. We are seeing a bit of a pullback here in the last week or so. Your perspective on the current state of the metals markets are you long right now? Are you waiting for a further pullback?
So I was long both physical gold and the miners for the past few months, very, very astutely so. We did sell the miners this morning, and the reason was, you have to look back at history. The last debt ceiling debate, debacle, whatever you want to call it, was in 2011. And during that time, gold did very well, because gold is not a miner. A miner is a stock, gold is money. So gold did very well, but the miners did not do very well. And if you look at some of the latest economic data and some of the components of my model, it just says it's just taking longer than I would have thought. Even my feelings and my visceral gut doesn't matter when it comes to investing money. I look at data, and the data clearly shows that it's just taking longer for this debacle to metastasize. And given that and the conflagration over the debt ceiling debate, since I don't like stocks in general, especially high beta stocks, miners had to go. I booked my gain in the miners. I should have sold it a few days ago, but I didn't. But I still have a very nice gain in the miners. Gold, on the other hand, is something I'll probably look to increase in the next few days, physical gold. Because again, gold is money. And given the volatility around gold and the direction we're headed, it's something I think right now in my portfolio it's close to 10, 11%. So it's up there. I would go as high as 20%. That's my max.
Fantastic. Well, Michael, we really appreciate your time today. Before we let you go, where can our viewers find you online? This channel is all about being aware and prepared, and obviously what you offer, there is a great way to be prepared as well. So where can people find you, and tell us a bit about your service?
So it's pentoport.com. It's the website. My email address is mpento@pentoport.com. If you have $100,000 to invest and you're a U.S. citizen, I will put you in the inflation, deflation, and economic cycle model. If you're qualified, I don't have to vet you to see if you're qualified for the alternative strategy, because we short the market. We don't do 60-40 portfolio investing. So we have various currencies and commodities, and whatever the second derivative of growth and inflation is, we'll follow that across our 5 spectrum between deflation and intractable inflation. So right now we're in sector 2, which is disinflation. I think we're headed for sector 1, which is deflation. It's just taking more time. But if you qualify for the portfolio, I'll take care of you personally. And the goal here is to make money in all markets, not just bull markets, but bear markets too.
Any last thoughts before we let you go, Michael?
No, I just wish your dad the best and your continued success.
Fantastic. You too, Michael. Thank you so much, and God bless.
You too.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.